want an exposure to a market or an
Everything they need in one place.
The world's foremost authority on individuals, advisors and institutions.
Hello and welcome to the Morningstar series, Market Reaction. I'm Emma Wall, and here with me today is legal and general economist James Carrick to talk about the UK economy. Hello, James.
Hi, Emma.
So we've had some unemployment figures out today for the UK. What exactly is new?
Well, unemployment's fallen a bit more than expected. Again, that always happens. The Bank of England is unsure what the level of unemployment is that will generate wage inflation. And wages have picked up a teeny bit, but are still low. But what we look at most is the vacancy rate. The number of unfilled vacancies is as high as it was in 2007. So there's an idea that there's too many people looking for jobs. But actually, companies are saying, we've got a job and we can't fill it. So I think that the labour market is tighter, no matter what the unemployment rate is, tighter than people think. And I think that wage inflation will pick up in the 2015 pay round.
And this is not the first piece of positive or looking positive economic news we've had this week, is it? We had some inflation data yesterday.
That's right. In terms of the consumer spending outlook, more job creation, a slight pickup in wages, but lower headline inflation has meant that for an individual worker, real pay is now no longer falling, it's pretty flat. But I've always thought that underestimated the strength of the consumer because it was always looking at per worker pay and ignoring the fact that we've got 2.5–3% more people working today than a year ago. So if you look at the number, for example, of dual earning families, that fell during the recession, but it's bounced back. And people always say, oh, but the main breadwinner is only getting a small pay rise. But you're ignoring the fact that the spouse has also got a job again. And so you've got two earners within a family. And I think people underestimate that.
So, you know, breaking it down, what we're saying is it looks like households are having a little bit more money coming in. They've got a little bit less money going out because food and petrol has not risen as much as people were expecting. So it's a little bit of easing off on that. Those two indicators were supposed to be the barometer for when we'd see interest rates rises. However, it doesn't look like we're going to get that until next year now. Would you agree? That's
correct. We thought with the strong growth, there was a good case for raising interest rates this year. Most people still want to see wage inflation, actually appear. And we think it will because of those high vacancies. But there is a good case to wait till January or April because that's when most people get their pay rise. So, you know, you get this data every month of pay. I think it's meaningless. Most people either get a pay rise in January, the start of the calendar year, April, the start of the fiscal year. They're the numbers that matter. So I think the Bank of England could take stock in either February or May when they've started to get some of those feedback of what pay has done in the 2015 pay round.
And the pressure from the market up until then, do you think they'll be able to hand that off?
Well, globally, we've had low inflation in Europe. We've had disappointing growth in Europe. So markets are not saying, you know, you're behind the curve, you need to raise interest rates. They'll definitely give the Bank of England time and room for manoeuvre.
James, thank you very much. This is Emma Wall for Morningstar. Thank you for watching.